Welcome! You're viewing the video version of the Pirls Stock Market Commentary, featuring the proprietary Bull Bear Point and Figure Market Breadth Summary Chart for June 19th, 2016. Happy Father's Day! Market breadth. With this past week's market decline, our Bull Bear Point and Figure ratio fell to 1.10 from 1.60 last week, remaining in bullish territory. The total count of securities in bullish or bearish patterns decreased 5% to 2,778. The count of bearish stocks increased 17%, while the count of stocks in bullish patterns decreased 19%. The Pirls PNF Market Breadth Summary Chart shows us a market now 3 consecutive weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. In order to receive the weekly email version of the Pirls Stock Market Commentary, free of charge, simply enter your email address in the space provided. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 163 points for the 5th decline in 18 weeks. At a positive 162.94 points, it has fallen back below the March 2015 and June 2014 highs, and continues below the 3 remaining highs above plus 100, as well as above all 5 bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in distribution mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 1 accumulation day and 5 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in distribution mode on higher average daily volume. Momentum. Continuing in a Woody's long trend, now at minus 95.11, the CCI 20 daily fell from 25.40 last week. It is now outside the plus or minus 50 range for a valid zero-line reject long entry signal, and has 5 consecutive days below zero for a likely change in Woody's trend at Monday 6/20 close. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 7 weeks ago, while the daily CCI 20 began a Woody's uptrend 2 weeks ago. Having begun a Woody's uptrend 5 weeks ago, the CCI 20 weekly fell to 89.95 below plus 100 for a trade exit signal from 105.94 1 week ago, following the zero-line reject pivot at a positive 15.23 within the plus or minus 50 range 6 weeks ago at Friday 5/13 close. We exited this trade simulation at Monday 6/10 open. The result of this trade simulation was a gain of 139.65 points on the Nasdaq Composite, or $2.66 per share of QQQ. Industry rotation the last 2 weeks. 4 of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: precious metals and REITs on top, banking and brokers on the bottom. Tech mixed. Bullish. Disk drives continues in the top 5. REITs has entered the top 5. Comp Tech has left the bottom 5. S&P Retail has left the bottom 5. Oil Services has left the top 5. Bearish, KBW Bank continues in the bottom 5. Brokers has left the top 5 and entered and leads the bottom 5. Gold and silver continues in the top 5. Focus this week from www.zerohedge.com. Is another financial crisis coming? This chart may have the answer. The following is the chart and some key points. For all the talk of market turbulence and volatility ahead of the Brexit vote, the reality is that after the sell-off scare in late January and February, the S&P 500 has barely registered any of the global fears that have roiled virtually all other foreign markets. And just 2 weeks ago, the S&P 500 trading less than 1% away from all-time highs. And yet, there is one chart that shows that underneath the placid surface of the S&P, not all is well. The chart is the following and demonstrates the substantial recent sell-off in U.S. bank stocks, which have been a near-flawless canary in the coal mine ahead of major market inflection points, and which have successfully predicted most major crashes in the past several decades. The key point here is that there were a couple of instances in the past where banks' underperformance of SPX bottomed out near the minus 15% range, namely in 1994 rate hiking campaign and in 2011-2012 around the peak in EU breakup fears. And then there are 3 instances where this metric went to minus 20% and over that level, and all those 3 were associated with turning credit cycles. We believe that a solid share of poor U.S. bank equity performance is attributable to expectations of rising credit losses outside of the commodity sectors. What kind of evidence makes us maintain such a view? First, it is willingness of credit investors themselves to finance the riskiest names. Deutsche Bank. Recent market moves suggest investors are beginning to position themselves accordingly in anticipation of such an outcome. The outcome in question, which the chart up top implies, a crash. We, however, disagree with DB. While the next move in stocks is indeed likely lower, and much lower at that, this will only serve as the precursor to the final all-in central banking gamble to stimulate not just inflation, but hyperinflation, helicopter money, which is precisely what we explained early this week in Wanted Policy Panic, why the biggest investors are praying for a market crash. They may get it very soon, and Brexit would be just the right catalyst. Thank you for tuning in for this week's Santu Pirls Stock Market Commentary, featuring the proprietary bull-bear point and figure market breadth summary chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend and a happy Father's Day, and that you are looking forward to a prosperous and productive week coming up, and, as always, wishing you true success.